Hi, my name is Caleb Griffith and I'm with Townsend Asset Management. Today I will be discussing 2020 tax changes and planning strategies. Thank you for joining me. I hope this presentation is helpful and gives you many insights into tax strategies available. Today we will cover recent tax law changes and the impact they have on your taxes. We'll look at 2020 government stimulus and financial relief. We'll look at tax bracket changes for 2020, as well as the CARES Act and the SECURE Act and how those may impact your taxes. We'll also review some strategies regarding Medicare premium adjustments, how you should consider that in light of tax planning, and some general tax planning strategies and checklist. In 2020, the government provided a lot of financial stimulus. If we look back at the timeline of the year, beginning early in 2020, the Federal Reserve was quite active by cutting interest rates and providing quantitative easing, which is basically open-ended purchase of assets. And then there was the Coronavirus Preparedness and Response Stimulus Appropriation Act and the Families First Coronavirus Response Act. Both of these just provided some additional resources for testing and needs of individuals. The largest stimulus passed in the United States history was the CARES Act at $2.2 trillion at the end of March. This provided some direct payments to individuals and help to businesses struggling. Later in the year, there was a $900 billion stimulus and relief bill that sort of provided some additional needs of individuals and businesses, similar to the CARES Act. During 2020, we must consider the changes to federal marginal tax brackets. What I have listed here is married filing joint and individuals. This is not all the filing statuses, but the two most prevalent. If you look at the column on the far left-hand side, you'll see what rates were in 2017. And then the green, yellow, and red show the rates in 2020. As you can see, they're similar, but the Tax Cuts and Jobs Act of 2017 did reduce marginal tax brackets for all taxpayers. What you'll see later in the slides is how we're coordinating the color coding to different tax strategies. Think green light, yellow light, red light. Green, meaning you want to accelerate income because you're in a low tax bracket. Yellow, you may accelerate, you may not. You have to consider what to do with your taxes. And red, you want to reduce taxable income. The standard deduction has increased from 2019 to 2020 just slightly, but these are the figures that you'll need to be aware of if you're married filing joint or a single filer. And why this is important is that you need to consider your itemized deduction versus your standard deduction. You're always trying to determine if it's better to itemize and what strategy may be available in the current year to help reduce your taxable income. The CARES Act, as I mentioned before, was unprecedented economic stimulus. It was $2.2 trillion, and it was the largest in U.S. history. About 25% of the stimulus was to go to individuals, and the remaining 75% was allocated to companies, industries, and hospitals. The thing that most people recognized with the CARES Act was the economic impact payments. This was $1,200 for single individuals if their adjusted gross income was less than $75,000, and $2,400 to married couples if their adjusted gross income was less than $150,000. For each qualifying child, there was an additional $500 to be paid. There was a phase-out, however, for $5 at a rate of $5 for every $100 above the thresholds. So theoretically, if you were a single filer and your adjusted gross income was above $87,000, you received no stimulus. Likewise, for married filing joint, if your adjusted gross income is above $174,000, there's no stimulus. If you're over 75 or 150, 75 for single, 150 for married filing joint, but below the max, you'll get a reduced impact payment because it phases out. If you did not receive your impact payment, you do have an opportunity to reconcile the credit on your 1040 in 2020. Look to line 30. This is where you'll reconcile the credit. On another note, the $900 billion stimulus that was just passed in December was $600 per individual with the same phase-out ranges as the CARES Act. Charitable contributions. There was a lot of changes in 2020, specifically the phase-out ranges and the carryover numbers, but I'll focus mainly on the above-the-line deduction up to $300 per individual that are allocated for those who are standard deduction individuals, and it's for cash-only donations. Also know, required minimum distributions were waived for 2020. At this point, we're in 2021, and there's currently no waiver. That can change at any moment, but for 2021, individuals aged 72 or older are required to take their required minimum distribution. Some key provisions of the Secure Act. They updated the required minimum distribution age from 70 and a half to age 72. This is important because there may be some planning strategies in delaying your required distribution. You have a couple more years to utilize income strategies before you may have to take out large distributions with your required minimum distribution. Contributing to an IRA. It used to be once you were past 70 and a half, you could no longer put money into your IRA. Now, as long as you have earned income, you can fund your IRA. Earned income is not the same as investment income. So think of it as having a job, having Social Security and Medicare tax withheld, being self-employed. That's earned income. And you must have earned income to qualify to be considered for making contributions. Inherited IRAs. This was the biggest change under the Secure Act. It basically took away the stretch IRA where you could name a beneficiary a lot younger than you and that they could take the distribution out over their lifetime. Now the distribution has been shrunk down to 10 years for most individuals, but there are a few exceptions to the rules. If you're a spouse of the original owner, you can treat the IRA as your own. If you're a minor child of the original owner, you can take the distribution out over your lifetime until at the age of majority, and then which you have a 10-year distribution rule. If you're less than 10 years younger than the original owner, you do not have to abide by the 10-year guideline, or if you're disabled or chronically ill. No distributions are required during the 10-year period and the point where you have flexibility. You can take it all out in 1 year, you could take it all out in 10 years, or you could take it pro rata throughout the 10 years, but you do have to have it removed after a 10-year period. IRA charitable distributions. This is still at age 70 and a half. So you must be age 70 and a half to be able to send money from your IRA to a charity. It's capped at $100,000 a year. It did not move in lockstep as the age for requirement distributions changed. Since that's 72, you do not have to wait to 72 to make charitable donations from your IRA to your charity. This slide goes through some tax bracket management and optimization. As we discussed under the marginal tax bracket tables, there are different rates at which you might consider different tax planning strategies. Under the 10% or the 12% brackets, you might consider things like IRA to Roth IRA conversions, or even deferring your itemized deductions. It would not make sense to itemize enforce things as itemized deductions in a year when you have a very low marginal tax bracket. If you're in the 22 or the 24% bracket, you might consider things like fully funding your 401k, making contributions to a deductible IRA, or bunching deductions like charitable donations so that you can itemize. If you're in the highest tax brackets, the 32, the 35, or the 37, consider strategies like an IRA to a charity. This prevents ordinary income from being realized. Consider shifting assets to lower income individuals, maybe your children or grandchildren. Also, consider your rental properties and how you might manage some of the income from that. There are many strategies on this slide that are available, so please take time to look at some of the options here and speak with your advisor to see how they may help you offset some of your taxes. These next couple of slides provide helpful tax planning and financial planning checklist. So I'll quickly go through the slides, but use these slides as a resource to help you develop proper planning strategies. For retirement planning, are you optimizing your traditional and Roth IRAs? Have you thought about an IRA to a Roth conversion? When thinking about your required minimum distribution each year, are there ways to optimize the distribution to reduce your taxes? Education planning. Oftentimes, younger individuals want to think about funding 529s for their children, but at the same time, there's good opportunities for grandparents to fund 529s for their grandchildren. This is a great planning tool. However, if you're doing 529s and a grandchild is your beneficiary, consider your distribution in the last year of the child's college education. This helps offset any FAFSA issues if they're applying for financial aid. Medical expense planning. Just consider how Medicare premiums may change based on the table we just reviewed. Charitable planning. Gift long-term appreciated assets. This is because it's more favorable than short-term assets. Short-term assets, they consider the basis. Long-term assets consider the fair market value. So, in a nutshell, gift long-term assets, do not gift short-term assets. Also consider donor-advised funds. This is a means to superfund and get a charitable deduction in the current year, but then possibly delay the deduction or the distribution to the charity over many years. Donor-advised funds are nice because you can make the gift anonymous, but also provide a tax impact today. And this is where you would consider your itemized deduction versus a standard deduction. Does it make sense to put a lot of money of a long-term appreciated stock into a donor-advised fund to get a deduction today, but also be able to impact many years in the future by your gift? Estate planning. In a lot of ways, this isn't necessarily a current year tax deduction, but if you have a large estate, it might make sense to make gifts to individuals. You can give up to $15,000 a year to each individual. So a husband and wife each could give $15,000 to each child, and there'd be no gift tax filing requirement. Also consider significant financial events. Do you need to reallocate your investments? Have you just received an inheritance and you're not sure what to do with it? Did you sell a rental property? These are things that we consider for our clients in regards to taxes, financial planning, and investment management. We want to ensure that you're using all available resources to maximize or to minimize the taxes that you're paying, to maximize your cash flow, and to make the best decisions with the assets that you have available. Thank you for joining me for this short recap. If you have any questions, please visit our website at assetmgr.com or email any of the individuals on the list below. We'd be happy to help you with any of your investment management, financial planning, or tax preparation or planning needs. Thank you for joining me today. We'll talk to you soon. Take care. Bye-bye.